What's going on, my fellow wealth creators? Matty Ice here. In this video, I want to provide some real life examples of using policy loans from my dividend paying whole life insurance policy, specifically for building wealth and also recapturing potential lost wealth as well. I'm going to give you 4 specific examples of how I've used my policy since I started it. At the time of this recording, just over a year ago is when I started my policy, and it's been an absolute game changer, which is why I want to do this video, because how often do we hear in mainstream financial media about how terrible whole life insurance is, right? It's a terrible place to put your money. It's a horrible rate of return, terrible investment. And for me, it's really frustrating because they're talking about all the wrong things. It's complete misrepresentation of what whole life insurance can do in our lives. And they're not telling the full story. They're only telling the part of the story that benefits them, so that you'll buy into that buy term and invest the difference strategy, which maybe that's right for you, maybe it's not. But how do you know unless you compare your different options, right? That's the biggest thing for me is I want you guys to see what's possible with these policies so that you can make the best decision for yourself. I know it's been an absolute game changer in my life. These things provide so many freaking benefits, and it really, really helps us accelerate the wealth building process in our lives by providing an extremely powerful financial foundation. All right. So that's really what I want to talk about in this video, and just kind of push back a little bit on mainstream financial media, because these things can be absolutely phenomenal. All right. So the first example that I want to provide is using a policy loan to purchase a vehicle. All right. So this was actually one of the first things it was the first thing that I did with my policy when I set it up. And I was able to take a policy loan within 2 weeks of setting it up. And I had access to about 90% of my cash value within the first 30 days within those 2 weeks. So a lot of the times when you hear mainstream financial media talking about how terrible whole life insurance is, what they're usually talking about is our traditional whole life insurance policies that were set up for like final expenses, burial expenses, and other reasons, I suppose, but not set up for high cash value. All right, those are the types of policies where the internal rate of return is very, very low. It's not very attractive. You don't get access to any of your cash value until like years 2, maybe 3, right? Those are the traditional whole life policies that these gurus are usually talking about. Again, they're only telling half the story, though, because did you know you can custom design a policy for high early cash value? Because that's what I did. And I have 2 policies now, guys. And I've been doing this for a little over a year now. And I had access to the majority of my money within the first 30 days. So I don't know what you're talking about, right? And that's the other side of the story that I want to tell. So I set up my policy, and within 2 weeks, I took a policy loan in order to purchase my vehicle. Okay, now I still paid cash for the vehicle. I just didn't use my own cash. All right, all I did, what I did was I changed where I put my money first before I made the large capital purchase. All right. And there's a few reasons I did this. Let's get into that. All right. But to clarify, when we're taking a policy loan, we're not using our own money. We're using the life insurance company's money, which allows our money in the policy to continue to get that. Typically, these policies net 3 to 5% tax-free, uninterrupted tax-free compound growth for the life of the policy. For me, that's a very efficient savings vehicle. We're not comparing this to investments. We're not going to get super rich, with whole life insurance. It comes down to how we utilize the policy in our lives. That's really going to determine how much wealth we build. All right. Now, I also like to preface that by saying, or just as a side note, that uninterrupted tax-free compound growth can turn into, even though it's only like my policy nets around 4%, that can turn into a very significant amount of money with enough time. So you start these things early enough, it can do really well. All right. But that's not why we're setting up the policy. All right. But but to get back to the first example here, purchasing the car. All right. So I borrow against my policy. I pay cash. I still pay cash for the vehicle. I just changed where I put the money first. So what that's doing is, number one, because we're still paying cash, I own the car outright, free and clear. Now there is a policy loan, so there's technically debt there, but what's really great about policy loans from a whole life insurance policy is that it's unstructured. Okay, meaning there's a lot of flexibility for paying that loan back. It's not like going to a traditional bank where you have to fill out an application, which you don't have to do with a policy loan. Where they check your credit, they want to know how much money you make, what your credit score is, etc. They don't do any of that. None of that matters with a policy loan. It's literally just how much do you want? Here it is, and it's in your account in 2 to 3 business days. All right, so that's a benefit as well, and that's part of the concept of becoming your own bank. By when you fund these things properly, you can start to finance these large capital purchases yourself without having to go to traditional financial institutions and go through that whole process. Now, sometimes there might be a benefit of doing that over a policy loan. That's a separate video, but in this case, it made total sense to me because the interest rate on my policy loan was only 5.5% at the time I took the policy loan out. It's gone up a little bit now, but most of my policy loans are paid off or about to be. We'll get to that in a second. But 5.5%, that's pretty good right now. At the time of this recording, when I was, because I was going through some traditional financial institutions, like I was getting quotes, I should say. I knew I wanted to buy the car from my policy, but I was still getting quotes. And guys, and my credit was decent, not great, but pretty good at the time of getting these quotes. The lowest I got for my interest rate was 10%. So do you want to pay 10% on a loan for your car or 5.5%? I mean, that's a rhetorical question. Obviously, it's pretty simple, right? So there's some interest rate protection there potentially when you use your policy loans for these types of things. That's number one. Number two, I already mentioned that it's a very easy, streamlined process. There's no application or anything like that. Number three would be also that because these are unstructured loans, meaning the policy, when you take a policy loan, that is automatically collateralized by your death benefit. The insurance company knows they're going to get their money back, right? Because everybody passes away at some point, right? And if you pass away with a policy loan outstanding, it just gets deducted from your death benefit. Okay. Now we always want to be paying back policy loans, but that's generally how it works. So because of that, the insurance company is never going to call us up and say, hey, you're 10 days late on your payments. We're going to charge you XYZ fees, and we're going to potentially come repossess your vehicle. Like, there's none of that because we have flexibility. We're in control. I'm in control of how and when I pay my policy loan back. There's nobody's going to be harassing me on the phone, knocking on my door, coming to take my car away if I fall on hard times and I can't make my payments for a couple of months and I need some breathing room to catch up. Try doing that with a bank loan. Not going to happen. Okay. Here's the biggest reason, though, in my opinion, to purchase why purchasing a vehicle with a policy loan is so powerful. It's because of the recapturing of all the lost wealth, the lost opportunity cost of paying cash for really any large capital purchase, but in this case, a vehicle, versus putting the money into a policy first to get that lifetime uninterrupted compound growth in the policy. Versus if you pay cash, that money is gone forever, never able to earn another dollar of interest for you ever again. I want to show you an example of this here really quick. Let me go ahead and share my screen. I'm just going to pull up a compound interest calculator, and I want to walk you through the numbers. This is the kind of stuff, guys, when I started doing this, as I was going down this rabbit hole of infinite banking and dividend paying whole life insurance, IULs, all that stuff, which I'm not a fan of IUL at all. But once I saw the numbers, that's what really started to make things click for me. All right. It went from being just kind of like theory, I guess, financial theory, to holy crap, I'm looking at the numbers. This is insane. All right. So check this out. Initial investment, so I paid $28,000 for my car. All right. Is a used 2008 BMW M3. It's a E93 model, V8 engine. It's so much fun. It's awesome. Drop a comment down below if you're into cars a little bit. Anyways, $28,000. Okay, now what we're going to do is we're going to see how much, if I paid cash and I didn't set up my policy first to get that uninterrupted tax-free compound growth, be able to leverage the life insurance company's money while I get that compound growth. I just pay a little bit of simple interest. That's fine. All right. What would that cost me over my lifetime? This is a big mindset shift around building wealth, guys. We have to start thinking about these things because watch how much money I was able to recapture over my lifetime by making one decision. And that decision was changing where I put my money first before I made the large capital purchase. That's it. That's all I did. All right. So the vehicle is $28,000. We're not going to do a monthly contribution. Let's do 40 years. So I'm 36. Maybe by the time I'm 76, I'm ready to retire, whatever. Let's just start with 40 years. Estimated interest rate. Like I said, these policies, when they're custom designed, because you can do that. I'll show you my policy later. I've done other videos breaking down my policy. I'll just link that down below. But these policies typically net 3 to 5% net tax-free compound growth for the life of the policy. Mine is going to do around 4%. All right. Now watch this. Here's the question. If I paid $28,000 in cash before setting up the policy, did the vehicle cost me $28,000 or did it cost me $134,000 over 40 years? 50, like what would it be at 50, 60 years? Like the numbers, the longer we go out here, the crazier the numbers get. In 50 years, that would have cost me almost $200,000 by paying cash. Because once you pay cash, that money is gone forever, never able to earn another dollar of interest for you ever again. But when we put the money in the policy first, then borrow against that to make our purchases, now our money is still getting this uninterrupted tax-free compound growth, in my case, around 4%. Now, and the only cost for me to do that is a little bit of simple interest that I pay on the policy loan, but we're recapturing all the principal because every time we make a payment back to pay off the policy loan, that money instantly shows up as cash value again that we can utilize again for another purchase, another investment, whatever. Can you do that with a bank loan? No. I mean, good luck. They're going to think you're crazy. All right. But this was the game changer for me, guys. Putting in 50 over the course of 50 years, I'm putting back almost $200,000 of wealth back into my empire, my pocket, my bank account, my policy in this case. So, and you think about how many large capital purchases we make over our lifetime paying cash, right? Like it's just insane. Like these numbers can really start to add up. So that is real life example number one, is buying a car. That was just an absolute game changer for me. All right. All right. Example number two, private money lending. This is where we really start to accelerate the wealth building process. I see videos out there talking about how to get rich buying cars with your policy. I don't subscribe to that financial theory. I do appreciate like what I just showed you, recapturing the lost opportunity cost. That definitely makes sense. But we're not going to get wealthy buying depreciating assets. Like the policy is going to grow whether you purchase the vehicle or not. It's going to do what it's going to do. All right. In order to actually accelerate the wealth building process, we need to be doing wealth building activities with our policy, right? Because again, we're not setting up the policy for the net internal rate of return. 4%, I would argue that's a really good high yield savings account type of comparison. That's great. But are we going to get rich doing that, build a ton of wealth doing that? Probably not, right? It comes down to how we use the policy. So example number two is private money lending. Now, obviously, this is not for everybody. How you build wealth comes down to your investor DNA, risk reward profile, et cetera. For me, I really like utilizing real estate to build wealth. I'm not a big fan of the stock market and stuff like that. Traditional, again, mainstream financial media stuff that they tell us to do. Maxing out your 401ks and all these tax qualified plans and stuff. Not saying there's anything wrong with them, but it's just not for me. I really like real estate. And right now in my life, private money lending makes sense. It's very passive. I'm not in a position right now to do like all the fix and flip stuff. Maybe later. We'll see. But private money lending is a fantastic way to use the policy, guys. Now, I've done other videos on this, breaking down my very first private money deal. I will link that down below. I'm actually 5 days away at the time of this recording from officially closing on it, being done with it. It'd be a 4-month deal from start to finish. It's been awesome. And I basically, here's how it works, guys. Just to keep it real simple, if you want to see a full breakdown of the numbers, check out the link in the description. But here's what we can do. This is what I did. Anyways, I borrowed from my policy. Again, I funded my policy enough to where I could do all this stuff, purchase the vehicle. I could still make a private money deal, etc. All right. I borrowed from my policy at 5.5%, and then I lent it out to a real estate investor to do his deal at 12%. And normally you would charge points on top of that as well. I didn't charge points on my first deal because I just wanted to break the ice, get the experience, etc. Definitely charging points on the next round because that can add up to a good amount of money. But here's the thing, guys. This is exactly what banks do every single day. And I don't know if you've noticed, but banks usually have the tallest, nicest buildings in pretty much every city across the world, at least in this country. So they're doing something right. Now, the moral hazard side of it and the corruption, that's a whole different conversation. But here's the idea. The concept of paying us 1% for a savings account, as an example. Okay, they're a little bit higher right now, but historically speaking, savings accounts don't pay diddly squat. Okay, they pay us 1%. Does that money just sit in the savings bank, then use that money, lend it out at a much higher rate? Of course, that's what they do, right? So they pay us 1% and then they lend it out at 4, 5, 6%. They make hundreds of percent return on that spread, and they do that every single day. And it's just printing money. Basically, they're leveraging other people's money to significantly increase their rate of return and also how much capital they have access to, right? That's all I'm doing here with my policy. And so to recap, borrowing at 5.5%, I'm lending out at 12%. While my money is still growing in the policy, guys, I'm making money twice. The only cost to doing that is the simple interest that I have to pay on the policy loan, which is a very small price to pay in order to create this type of wealth building scenario where I'm making money twice, not to mention the other benefits that I get for having the policy. It's not just about rate of return. The death benefit that we get with this too is just like there's so many benefits to the death benefit, right? So I have all that, but now I'm starting to kind of print money the same way that the banks do. In private money lending, it might sound risky, and I just did a video on this. It's not nearly as risky as it might sound or as people might say that it is. The idea being you're going to lend all that money to a complete stranger you've never met halfway across the country. Well, yeah, I am going to do that because I know what I'm doing. Now, I'm not an expert at it, all right, but I've had good coaching, training, great mentors, etc. When you do it right, it's actually, in my personal opinion, not financial advice, in my opinion, it's way safer than gambling money in the stock market. I could tell you that because, again, acting like the bank, what does the bank do when you take out a mortgage? Well, they have a first lien position against the property. So if you don't pay your mortgage, what happens? The bank seizes the property, right? They can foreclose on that property, sell it to recoup their money. It's the same exact thing with private money lending. You have a first lien position on that property. And if for whatever reason the deal would go south, you need to foreclose, you could take possession of that property. So it's backed by a hard asset. This significantly reduces our risk in the deal. Not to mention there's other things that we do, like not going above a certain loan to value. Obviously who you work with, right? Again, I talk about that in other training. I'll leave that down in the description below. But this is just another example of how I've used my policy to accelerate the wealth building process in my life, right? So really, really cool stuff. You guys, if you're interested in learning about private money lending, potentially becoming a private money lender, I would recommend at least looking into it. It's awesome. I will link the exact coaching program that I went through. It's super cheap, in my opinion anyways, for what you get. And it's a step-by-step blueprint for like start to finish how you become a successful private money lender. I'll link that down below if you want to learn more. All right. Example number 3, consolidating credit card debt. This is huge. All right. Now, the way that I did this, I didn't have credit card debt that I needed to consolidate. I actually consolidated my mother's credit card debt. I was having a conversation with her one night at dinner, and I did not realize how dire her financial situation was. She had 13 different credit cards that she was making minimum payments on. 13. Talking about a lot of money every single month, just going right out the window. And of course, what are the interest rates? 25%, 30%, whatever. I mean, just outrageous, right? And what's happening is that's just sucking out wealth from that person. In this case, my mother's life. Not good. Okay. So these policies can be a phenomenal way to pay off debt. very quickly too. Now, again, that's another video, like how the accelerated debt payoff strategy would work with a whole life policy. But think about this. If you have credit card debt or really any high interest rate debt, why would we pay 10%, 15%, 25% when we can consolidate all that into our policy and pay 5.5%? Right now, I think it's 7%. Every company is a little bit different, like 5 to 7%. Not to mention that it's simple interest on the policy loan versus the compounding interest that you typically see with credit card debt. Not if you're making the minimum payment usually, but anyways, my point is consolidating that credit card debt or high interest debt can be a massive opportunity. Now, this really only works if you're able to save money at the same time. So the scenario would be that maybe you make a decent amount of income, you have this credit card debt, maybe you're starting to catch up, but you're only making the minimum payments, but you are still able to save money. You don't want to put it all into this credit card debt yet for whatever reason. I would definitely recommend setting up or at least considering setting up the policy first. You have to fund it properly. Okay. So you have to be saving at least a little bit of money in order for this to work. But you set up the policy and then you take a policy loan, pay off the credit card debt, and then you pay back the policy loan at a much lower interest rate, guys. And within 30 or maybe 60 days, her credit score like shot through the roof. And she pays me every single month to pay back the policy loan. Because again, we're setting up our own banking system here. We want to be responsible bankers. Okay. So we're paying back that policy loan, but it's saving her, I think it was like $800 per month. Like it put $800 per month back into my mother's pocket every single month. It shot her credit score through the roof. She's not drowning in credit card debt anymore. She only has 2 credit cards that she uses now for the points. She's in a much better financial position because of the policy. All right, changing the way we do things. All right, final example, number 4, is investing in your business. So this is, guys, these policies are phenomenal if you are a business owner that regularly needs financing, funding, capital for working capital for your business. These things can be a lifesaver. Okay. Now, this hasn't been a huge use case in my particular example because I'm primarily using my policies for the private money lending. But if you're a business owner, I mean, I guess I could say that private money lending is kind of like starting a business, right? But these things can be an absolute game changer for setting up your own banking system where you become your own source of capital. Now, again, it only works if you're able to save money. Hopefully, as a business owner, you've been able to save a decent amount of money. But where are you saving that money? Is it in where are you stashing the money? Is it a checking account, savings account, whatever? And ask yourself, what is that account doing for you? Versus what could a custom designed dividend paying whole life insurance policy do? Like I get all these benefits, right? You get the safety, the tax-free compound growth, right? You obviously have the death benefit, et cetera, but you also have liquidity, right? Liquidity is so important. Access to capital is so important when you're in business. So why not establish your own source of capital that when you utilize the money, your money is still compounding in a policy? Not to mention, I mean, guys, I know if you're a business owner, you're probably going to resonate with this and know what I'm talking about. It can be a real pain in the ass to get the capital that you need when you need it from traditional financial institutions. And then not to mention alternative forms of financing, merchant cash advances and stuff are just can be ridiculously expensive and detrimental to the business, right? So why not set up our own banking system? And when we need capital, we borrow from the policy and we pay that policy loan back over time. Meanwhile, our money is still compounding in that policy, and there's no application process. There's no red tape. There's no terms and conditions. There's no no credit checks, you don't need to provide income statements or anything like that. It's literally you log into the portal or call the company. I need XYZ amount. Send it to me. There's no questions asked. And it's in your account in 2 to 3 business days. Faster than that if you set up a cash value line of credit, which is another video. But guys, using this to invest, these policies to invest in your business is just incredibly powerful. Not to mention too, again, with the death benefit, you're protecting your loved ones if something were to happen to you, if you passed away unexpectedly. How would your family survive financially? Do you have stuff in place for that? Hopefully. All right. But that death benefit, it gives you so much peace of mind knowing that your loved ones are cared for, protected financially if something were to happen to you. So that's a whole other benefit. So anyways, those are 4 real life examples of using policy loans from a dividend paying whole life insurance policy that I have personally used so far. And it's been an absolute game changer in my life, in my my mother's life as well, consolidating all that debt. It's just these things are so powerful, guys. And again, we're not setting them up as something that we're going to do instead of investing. No, we're doing both, right? That's why they call whole life insurance the and asset, because we don't have to choose one or the other. These things provide a very strong financial foundation, especially when you set them up right. And then they give us the liquidity that we need to build wealth like we normally would, whether that's private money lending, making large capital purchases to recapture lost opportunity cost, investing in our business, etc. It's just a really strong financial foundation, very efficient savings vehicle. So that's it. I hope that was helpful, guys. If you have any questions, drop them down below in the comment section. Make sure you check out all the links in the description for additional training, tools, resources about whole life insurance, how I'm using it in my life, and we'll go from there. All right. To your success, Matty Ice is out.